Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for January 25th of 2026. We'll start off the chart pack this week with a discussion of inflation, interest rates, and the Fed. We have a Fed meeting coming up this coming week. Be very interesting to see what stance they take. I think the consensus is that maybe they do nothing, although there are arguments on both sides of the aisle on this one. You can see here, this is a forecast looking ahead, taking a very dovish view, which would, seem to infer lower overall rates, or the hawkish view, which would be higher rates for longer. You can see here very clearly in the green line, the most hawkish tone would be that we don't have any further rate decreases, or basically no net change here in 2026. Whereas for the dovish camp, you've got multiple rate cuts over the course of the year. Now, again, we'll take a look at some charts here coming up. We'll argue in both sides of this right now. So it really puts the Fed in a tough spot. Now, the consensus is for a couple of rate cuts, so it tends to fall a little bit more on the dovish side. But again, there are very strong arguments on the other side of that as well. So we'll take a look at that in succession. Here we have non-farm payrolls. This is really the area of focus that I see the Fed, at least in terms of speeches made by Federal Open Market Committee voting members. They talk about the labor market slowing down. You can clearly see that here. So again, just to summarize, if you go back to December of 2024, track this. This is the 12th time that we've had 3 consecutive months on a moving average basis of job losses. In fact, this number looks a little bit like 22,000 jobs lost on average over the last 3 months. Again, moving average. Now that's happened. This is the 12th time that has happened in modern history, and the last 11 times we were in a recession. So from this vantage point alone, the whole concept of the labor market slowing, if that is your focus, then yes, you're inclined to want to reduce interest rates to try to get out in front of that. Now here we have core PCE inflation. This is the year-over-year rate of change, courtesy of Charlie Bilello. We can see here that this has been rather stubborn over a period of time. In fact, you could argue, we reached 2.6 at one point, and a couple of points in here, and now we're 2.8. Again, we've had tariffs, a tremendous amount of tariffs. We'll see that here in a few charts. But just suffice it to say that we've had sticky inflation that's just hovering just underneath that 3% range. And again, just to be clear, this is core PCE. So this strips out the volatile components of food and energy. But this is the preferred gauge that the Fed uses to track interest rates. And so if you're looking at the Fed's dual mandate from the perspective of inflation, you might be inclined to not want to lower rates. Again, you've got a dual mandate, a stable labor market, stable employment, as well as stable inflation. And we have two kind of different signals here that we've just looked at, and they both conflict with each other. So again, there's a lot of speculation out there. There's perhaps some expectation that's been built into the market, and the market does not like negative surprises. So I would say the best view of what's going to happen at this this next Fed meeting is that there will be no change. Now we'll dig into PCE to its components. Here we've got the cyclical items of exposure. That has a long-term downtrend. Again, sticky. It's not going down at an accelerated rate, but it is moving down on a year-over-year basis. So positive there. And if you look at the less cyclical areas, also sticky to maybe slightly up. Again, these are elements that you want to see. If you're really focused on inflation, this is not giving you a real powerful signal that inflation is coming down abundantly. Now we'll look at housing. These are this is one of those areas that's rather important to inflation given its weight within this particular measurement. You can see that this moderates. We did have some missing data here because of the government shutdown. But again, housing as an influence on core personal consumption expenditures is moving lower. And goods here probably with the influence of some tariffs is moving a little bit higher. So you see, call it, goods related impulse to inflation moving a little bit higher, which is being offset by housing. And I think you get some of these offsets, and that results in kind of that inflation number that just doesn't move very much, or hasn't, at least recently. Here we have OER, owner's equivalent rent of residences. This is actually very, very important to core CPI, consumer price inflation. And you can see, as we've been talking about this for at least 2 years now, we saw the peak post-pandemic. That continues to drive down, still well above levels that we saw pre-pandemic. And if you draw a line of best fit, it probably looks a little bit like this, perhaps. So we are getting a lot closer to that line of best fit for all the data points that we see, at least in this particular century, and they are coming down. So these are positive developments as it relates to inflation, notwithstanding the impacts of tariffs and things like that. Interesting tidbit here, sifting through the data. This is a food costs away from home. Here in the blue, and food at home. So think about this like your grocery bill, and this would be like restaurants, right? So you've got an interesting dynamic going on here, is that you actually have food at home moving higher, and so this is kind of goes back to this whole conversation of the K-shaped economy, when you have lower income folks that are spending a greater percentage of their paycheck at the grocery store, and you can see that they're feeling it here because that rate of inflation is moving higher, even if it's that overall rate of inflation is in the aggregate lower than the consumer price index. You see food away from home, that seems to be relatively steady, if not picking up slightly here, but we know that clearly we had a bump, and again, these numbers represent essentially year-over-year changes. So even though, we have lower overall year-over-year rates of change, all of this is still in the system. It's not like we've had outright deflation. We just had a reduction in the rate of gain. So when we got to 22, 23, prices reset at a higher level, and they haven't come down. They're just moving down at a lower rate, just to be clear. Interesting chart here from Apollo that requires a little bit of explanation. So again, we talked about this K-shaped economy where lower income folks don't feel like they're as well off as the other cohorts, the upper income folks. You can see here estimated inflation growth by income groups. So bottom 40% is in the green. You can see that level here is in the aggregate higher than the middle income and then the top income groups here. Both of those cohorts are lower. They're all moving in the same direction. Again, there's no huge deviation in terms of the relationship between these groups, but you can see that clearly you've got lower income folks that are feeling it more and are witnessing greater overall inflation than the rest of the world. Atlanta Fed business inflation expectations. This is very important to what I'll say capital spending, CEO confidence, those types of things. You can see that that's on balance moving lower. Their 12-month unit cost expectations tracking a lot closer to what the overall rate of inflation target is for the Fed. So this I view as a positive development, at least from the business standpoint. So here we have wages, and we've kind of broken this out between the lowest earning quartile in the blue and the highest earning quartile here in the amber lines. You can see that both groups have witnessed wage declines, and we did have a very tight labor market, and we talked a lot about the very high quits rate and those types of things a couple of years ago. Well, that obviously has moderated here, but what we've seen is that the lower wage earners have witnessed a more dramatic decline in overall wages. Now, granted, where they are now is still very much positive, and you could argue that the average wage here is still conducive, but you can see the pain that they felt more egregiously than the top wage earners here that also witnessed a decline, but not nearly to the extent that the lower wage earners did. So here's a chart on tariffs that was promised. This is out of Bloomberg. This is basically the average tariff rate. And again, you got to go back to Smoot-Hawley and 1930s and the protectionism that existed back then on really the eve of the Great Depression. Not that this is going to turn into that, but I'm just saying that we're at a level here that we haven't seen since really before World War II. And even with all of the bluff calls and things like that that we've seen out of the administration announcing big tariffs to gain effect and gain leverage in negotiations and then backing off of that, so on and so forth, we're still at an average effective tariff rate of about 14%. Interesting chart here, Haber Analytics. This is liquid assets. This is basically a solvency test for corporate America. And so this is telling you that you have a very high liquidity ratio, which is good. So when you talk about companies and their ability to be nimble in the face of changeable economic conditions and to changeable opportunity sets, that companies right now have a pretty high liquidity ratio as defined by liquid assets, basically divided by short-term liabilities. Mergers and acquisitions we talk about quite a bit here. So this is here we have total U.S. domestic M&A announced deals, a 12-month moving average. And in a good sign, we've seen, over a period of a couple of years, we've got that moving average that continues to move higher. Total M&A deals have spiked. This chart is here to caution us that a lot of these are in the AI space and driven by these valuations that are moving higher. So, the net deals are trending higher because valuations are higher for takeout values, so on and so forth. And but a good sign nonetheless. This is obviously inherently cyclical, and data goes back to 2016. That we are on the upswing, and so this is a sign of businesses and executives wanting to put capital to work and increase the velocity and the returns on their investment. So I do take this as a positive sign, even though it may be punctuated by AI-related acquisitions. Talk about income levels. We were just talking about that a couple slides ago. We've got real disposable income still positive. 3-month annualized 0.1%. The year-over-year number is at 1%. Again, that's positive, but not robustly so. You can see that this does become quite a noisy data set. But if you go to real PCE expenditures, 0.3% over here, so slightly different or different definitions, both pointing at higher incomes, but not, I would say, robust incomes at this point. And then PCE consumption remaining strong. Here we've got PCE expenditures. We look at durable versus non-durable goods, and then we have services. Again, all of those in the aggregate trending higher. I don't see any particular acceleration in any of these data series. At the same time, we've got a savings rate which is going down because consumption is moving higher. We do see higher credit and charge card balances, but we don't see necessarily an acceleration of delinquencies in that regard. So things are a little bit tenuous now. But again, all the data trends are moving in a reasonably positive way. Here we have mortgage markets conversation, a little housing discussion here. We've got 30-year mortgage rate, which has trended down, because we have had some volatility in the fixed income markets and the 10-year treasury, and we've seen maybe a little tightening in the spreads between the 30-year mortgage rates, which are indexed to the 10-year treasury and the treasury itself. So that spread is tightening here. You can see as we go further into this net rate tightening cycle, if you will, with rates being higher overall, that more and more mortgages on the books are at higher rates, and you can see that slowly trending higher as these mortgage rates move from basically 2.5%, 3% up to a level that's more consistent with like 6.5%. That this line is going to continue to trend higher over time. Pending home sales, we talked about the struggles in the housing market, and again, no change in there. We've got pending home sales that are flat in slight decline. Month over month, we had a huge drop in that, and the year-over-year number was influenced in a very similar fashion. You see the sales market for existing homes is very sluggish right now. This is something I thought was really interesting, and it has some local ramifications for my home here in Cedar Park, for development. And so what this tells you is that you have you have a very awkward gain to lease situation in a lot of these metro areas, and you take the 20 areas, and Austin here just happens to be the worst position now. And so basically, you've got people coming in signing new leases. And those lease rates are moving lower. And what that's going to do over time is you've got renewals on a 3-year average that have been positive. These new leases are going to influence what happens at renewal times for existing renters. And so, when you have these blue lines that are out of balance, particularly in markets where they're out of balance with renewals, eventually you're going to see renewal rate and overall lease rate declines for multifamily. And what that does is put a stark disincentive for development of multifamily if your rents are going lower, or at least on projects where multifamily construction is a part of the mixed use development, it's going to delay the phasing of those. Here we have private construction spending. This is home improvement now. So this is residential home improvement. Very interesting development. So this would be here, the pandemic here, and it was already moving higher, and it just accelerated. You see a lot of reinvestment into individual residences. Again, I have really not much more to say other than it's a very interesting data series. Now, it's showing a bit of geometric rise here, but just in terms of the aggregate level, it's an extremely high rate. Now, we did get the Kansas City Fed data last week, and we'll just call it the composite index is flat, and it's been negative for a while. And then we had a little green shoot here. We've got manufacturing on new orders. Current new orders are, again, roughly flat as they have been, negative for a while. Future orders, at least as it pertains to the outlook for companies that responded to the survey of the Kansas City Fed within that Fed district, are looking better. So this is extremely consistent with what we've seen at Dallas, Richmond, and in some respects, the Philly Fed and the Empire State Fed. Asia exports, interesting here. We've talked a lot about the trade issues with China and what I do believe is going to be a lot of back and forth and gamesmanship with regard to trade and tariffs. You can see that exports to the U.S. from Taiwan, Vietnam, and Thailand have really exploded, and this is a function of kind of this alternative shoring, if you will, or reshoring to some extent. But that reshoring takes a lot of time to bring manufacturing back domestically, or you just simply find other areas to make it other than China. You can see China exports to the U.S. Continue to move lower, and you've got other areas ex-China that are trending higher. But in particular, these areas that while they don't, Taiwan, we could talk all day on, but obviously Vietnam and Thailand that are, kind of a capitalist, socialist, market. Gold futures, a lot to talk about on gold. I think suffice it to say that it is proving to be quite the alternative asset, showing a high correlation though with equities. So again, it's been very sexy to own gold over the last year, and you can see that gold volatility has certainly picked up, and I think that's going to be the call for 2026. I do think gold and metals in general are going to continue to show strength. Now you look at copper. We've got a chart on copper, and there's, I think, a unique reason why copper's showing a lot of strength lately, and we'll talk about that. But silver, palladium, the other metals are all participating in an accelerated rate of growth right now. And again, I think it's not unhealthy to perhaps take some profits now, and because you generally don't see a geometric rise like this without some type of reset or hiccup that might allow you to buy it a little bit cheaper again after having taken profits. So this is interesting. We've got gold that has overtaken treasuries and central bank reserves, foreign exchange reserves. This is here, this would be like official treasury holdings, which on balance have remained relatively flat, even though we've seen some declines from significant declines in China, but you've seen some increases in other country central banks. But what's interesting here is that gold demand and gold prices are influenced to some extent by the fact that you've got more of that gold being held in reserve. So this chart really talks to what I was describing a couple slides ago with regard to treasuries being held by foreign central banks as part of their reserves. And you can see here in this chart, we've got a huge spike in holdings of U.S. long-term securities in the European theater, which, again, as I said, in that slide a couple minutes ago, China has been rapidly reducing its holdings of treasuries, but that slack is clearly being taken up by other areas, including Europe. So we talked about the issues in the commodity price basket for metals, and all of the metal prices have gone up. Copper is certainly participated in that too, but what's I find particularly interesting in this chart is that the supply of copper, again, you've got to mine copper, and obviously you can recycle it too, but the supply of copper is set to decline over the next, call it 15 years or so, and I think that has a very strong influence on the future of copper prices as it relates to copper's participation in the overall commodities metals basket. I just see we're on the eve of what I think will shape up to be kind of a commodity super cycle over the next 15 to 20 years. Here we have we'll transition into the kind of the equity markets, if you will. So this would be where the institutional exposure is and the sentiment amongst the institutional investors for equities. So 4-week moving average, we see that maybe rolled over, but still very high. So institutional investors are very much invested in our risk capital markets. You've got individual investors. We look at this from time to time. I think it's important to note that, that the bullishness, I guess, of the individual investors has come off its peak. Bearishness has come, off of its trough. It's overall individual investors are still very, very bullish, and we've seen, net positive bullishness for some time now. Now we talk about some of the dynamics of the market, which we've been describing to you for a number of weeks now. And I think what's really interesting and really important is that we've seen some leadership change, and I think it's a very healthy development, even though we're dealing with a fairly richly valued market. Again, this S&P 500 now that we have is certainly different from the S&P 500 that of our fathers and uncles and such. But we see the equal weight versus the capitalization weighted, which is the S&P 500 that is quoted. Again, it's dominated by the very large mega cap companies, the hyperscalers, the Mag 7 to some extent. But the equal weight is showing renewed resurgence, and this has been a multi-month trend now. So we have seen a clear rotation out of the Mag 7 into some of these other better performing areas. So that's equal weight versus cap weight, much better performance out of the equal weight. And then also growth versus value. You can see the growth piece of this rolling over and the value piece picking up. Now there's still a gap in terms of overall performance if you go back to 2020, but that gap is just now beginning to narrow as we see kind of this change in leadership in the market. So continuing the conversation here, we have large cap stocks that have dominated the market for quite some time, and we see better performance now from small caps. In fact, a number of consecutive days is something we haven't seen in a while. So small caps are performing better. You can see that represented here as well relative to large caps. So here we have several themes that are evolving in the change in leadership here. You have small cap performing better than large cap. You have value performing a little bit better relative to growth. And you have the equal weighted stock index performing a little bit better relative to the overall index now. Something else that we've been watching actually for a number of months now is the quality factor too. And this is in the small cap area. You got the basically the Russell 2000 index here. So you've got companies with negative earnings, and we know that that like 40% of the Russell 2000 has companies in the index have negative earnings. But look at this development. You go back to call it like the beginning of fall. That those lower quality companies have actually performed better than companies with positive earnings per share. And these are some of those anomalies that you encounter at some points in time where you just fundamentally they don't make sense, but that these kind of like low quality companies are getting a bid and getting more interest from speculators. And that's fine. That's just a part of the market. But this is very interesting that as we're seeing this rotation, and particularly into small caps, into the Russell 2000, that we're getting more juice out of companies of lower quality. Talk about profit margins. We've been discussing this quite a bit. You can see overall margins that are moved higher and are elevated and kind of in rarefied territory. And I think this is honestly both good and bad. We'll see, kind of both sides of that argument here in a second. But, suffice it to say that operating margins, go back to pre-pandemic, that whole decade, we're at a higher level now. And you can see a little bit about maybe where that's coming from. We have the tech-related contribution, and this is a very interesting dissection of the profit conversation for the S&P 500. And you can see that a greater percent of the overall profit margins being generated by the index or companies in the index are coming from technology. And that's not to say that the rest of the market, the non-tech portion, is not doing well, but you can see here going back, non-tech related contribution, the line of best fit is probably kind of like where it is now, whereas you see most of the incremental gain is coming from technology. So continuing the theme of this change in leadership here, one thing I want to stress is that, while Mag 7 is not generating the level of earnings or expected to generate that level of earnings that it has in the past, 23, 24, 2025, we'll get fourth quarter, we're in the middle of that getting fourth quarter earnings right now. But again, not that they're going to be negative, but Mag 7 earnings are going to, expected to be lower than the last couple of years, and even still more so in 2026. Whereas the S&P 500, if you exclude those Mag 7, you can see clearly they're moving higher. And when you get into the latter part of this year, that earnings growth is looking or expected to look very, very close to one another. And so, even these estimates of future earnings would tend to support the rationale behind why we have this change in market leadership right now. It's a very interesting scatter plot. This is valuation versus probability, so a little bit of explanation here. This is forward net margin. We just talked about that. We're over 14%. We're over 14% in net margin. We know some of that's coming from technology. And then also our price to earnings ratio, we're about 22 times. And again, that's also influenced by technology and also influenced by these hyperscalers and these very, very large companies that dominate this index. But having said that, data don't lie. And so when you plot where we are in terms of margin and also valuation, it puts us here. And these are all outcomes going back to 2005, and you see these different color coded categories represent different periods of time, and from basically over this last year, we've been in pretty rarefied air. And so the argument here is, if this is your starting point for investment, then what should your expectations be, and how should you be allocated? Because this kind of sets the bar real high for you to, for improvement, right? I mean, you can't really from here expect a tremendous amount of, multiple expansion, because that's just historically, at least going back to 2005, we just haven't seen that. And we also haven't seen the ability to continue to drive more profit margins. Now, AI could change that, but we just don't know that yet. So this just makes it a little bit more of a difficult spot if you're just starting out investing. We'll switch gears and talk just for a second about the income markets. Here's high yield implied default. And you can see that is very, very low. In fact, it's very consistent with the lows going all the way back to 2006 to 2008. And so, this is, as I've said many times before, when you have implied defaults that are this low in your high yield component, that's a very low probability of recession factor, which very consistent with the chart of the recession probability that I showed you last week. We've got a lot of data here from Bank of America. This is from their periodic global fund manager survey. And, we talked a little bit before about the relative complacency of the market. And certainly a few slides back, we showed you the relatively high confidence level that we had on the part of institutional investors. and frankly, as well as individual investors. But this we'll talk specifically on the institutional front. Fund managers are very positive. Their investor sentiment is the highest since July of 2021. And I'll look down here, and their average cash level is very, very low, 3.2%. So they're invested, they're confident, and in this slide, what's evident here is that when surveyed, a lower percentage of them have taken out protection against the sharp fall in equities. Now, again, in our firm, we utilize structured investments to try to help cushion that downside. That we have protection against price erosion, for market declines of anywhere between 10 and 50%. So, we are building protection in, but suffice it to say, a lower percentage of overall fund managers are protecting against that downside because they are confident and because they are definitely invested. Well, in the chart pack this week with a couple items of general interest, this one here represents data from a survey by Pew Research Center on how people feel about AI in their daily life. And it does vary greatly by country, interestingly enough. Here in the US, half of the respondents are a little bit more concerned right now than excited. So we're still early on in this whole adventure. And another 38 are just equally concerned as they are excited. So think about like almost 90% of people here, have a certain level of concern about how AI is going to impact their daily life. And then only 10% are more excited than concerned. You can see, if you go take the 25 country median, then that's a little bit slightly more equitably distributed. But again, suffice it to say that there's still a fair amount of concern out there in the general public across the globe about how AI is going to be utilized and how it's going to impact their daily lives. So I came across this slide, really kind of highlights the climate issues that are in the national debate right now. And there are pretty visceral arguments on either side of that. But I just tend to always rely on data, and I think this chart is pretty telling and interesting at the same time from Statista and data from NOAA. So this is basically federal government data. But if you look at the 1901 to 2000 average, that much of the call it preceding years leading up to 1901 were colder than average. And then obviously the years after seem to be colder than average, but that really changed around late 70s when we really hit kind of a, establish our carbon footprint and, proliferation of vehicles on the road. Again, not being political here, just saying that the average temperature has gone up about, several degrees here, which has some pretty strong implications, not just from a climate standpoint, but also from an economic standpoint, if you look out over the next, 2 to 3 to 4 decades. Well, the last slide here in the spirit of public interest is something that doesn't necessarily impact our investment markets, but I think is very interesting nonetheless, is that we have a much higher percentage of Americans who are living alone, single member family households. And what's really interesting is, this is about as linear a chart as you can get, data going back to 1960, that, back in 1960, only 13% of households had one person. Now that number is 29%, and that represents 40 million Americans. Again, I could, spend some time and kind of conjure up how this is economically sensitive, as you're tracking household formation and household spending and things that are aggregated at the household level, can be skewed certainly if you have an increasing and rising number of single member households. So anyway, just thought that was very interesting. And there you go. That's all the charts that we have for this week. Hope you have a wonderful week, and we'll talk to you again soon. Take care. Bye.